Jim Rogers' statement, "Bottoms in the investment world don't end with 4-year lows, they end with 10 or 15-year lows," reflects a fundamental principle of investing and stock market analysis. Essentially, Rogers is highlighting the idea that significant market bottoms, where assets reach their lowest point before starting an upward trend, are often characterized by extended periods of decline and consolidation rather than short-term fluctuations. In this explanation, we will look into this statement, provide some examples from the stock market, and use charts to illustrate each case. The Great Depression, 1929 to 1940. Jim Rogers' statement is exemplified by the Great Depression, one of the most significant financial crises in history. The stock market crash of 1929 marked the beginning of the Great Depression, but the market didn't hit its ultimate low until 1932. Here is a chart illustrating the prolonged decline and eventual recovery. Great Depression. As shown in the chart, the market didn't reach a bottom until several years after the initial crash. The dot-com bubble, 1999 to 2002. Another example of a prolonged market bottom is the dot-com bubble. The bubble burst in 2000, but it took more than 2 years for the market to find its bottom. Below is a chart representing this period, dot-com bubble. The market's decline extended well beyond the initial crash, in line with Rogers' statement. The financial crisis, 2007 to 2009. During the 2008 financial crisis, the stock market experienced a sharp decline. However, the market didn't truly bottom out until early 2009. Here is a chart illustrating this period, financial crisis. As shown, the market continued to decline for over a year before reaching its ultimate low. Japan's lost decade, 1990 to 2000s. Japan's prolonged economic downturn during the 1990s is a prime example of a market bottom lasting much longer than a few years. The Nikkei 225, Japan's stock market index, peaked in 1989 and took over a decade to recover. Below is a chart representing this period, Japan's lost decade. The index experienced a prolonged period of decline and stagnation before showing signs of recovery. Gold's bear market, 1980 to 2000s. Even commodities like gold can demonstrate extended bottoms. After reaching a peak in 1980, gold entered a bear market that lasted for over 20 years. Here is a chart illustrating this period, gold's bear market. Gold prices experienced a long-term decline and consolidation before a sustained uptrend began. Bitcoin's bear market, 2017 to 2019. Jim Rogers' statement is not limited to traditional markets. It can also apply to cryptocurrencies. After the cryptocurrency market boom in late 2017, Bitcoin entered a bear market that lasted until early 2019. Below is a chart representing this period, Bitcoin's bear market. Bitcoin's price took over a year to stabilize before showing signs of recovery. In each of these examples, the market did not recover quickly from its initial decline. Instead, it went through an extended period of consolidation, and in some cases, the bottom took several years to be reached. This aligns with Jim Rogers' statement that bottoms in the investment world are often characterized by long-term lows. Investors should take away several important lessons from this concept. Number 1. Patience is key. Recognizing a market bottom and waiting for the right time to invest is crucial. Rushing in after a short-term decline may not yield the best results. Number 2. Long-term perspective. Investing with a long-term horizon can help withstand market downturns and take advantage of eventual recoveries. Number 3. Risk management. Extended market bottoms can be emotionally and financially challenging. Proper risk management and diversification are essential. Number 4. Fundamental analysis. In prolonged bear markets, it becomes even more critical to analyze the fundamental health of assets and companies. Number 5. And perhaps the crucial one, contrarian opportunities. Extended bear markets can present contrarian investment opportunities, as assets may become undervalued over time. In conclusion, Jim Rogers' statement serves as a reminder that market bottoms are typically not short-lived events but often extend over several years. Recognizing and navigating these periods of extended decline is a critical skill for successful investors. By examining historical examples and charts, we can see how this principle has played out in various markets throughout history, reinforcing the importance of a patient and long-term approach to investing. Thank you for watching this video. To stay connected for more such videos, please subscribe to the channel, comment, like and share this video. Thank you.